Hello, left fielders. At LFI, you know our focus is on networking and education. Mark your calendars because we're going to have a full day of it dedicated to you, our limited partners, at the Best Ever Conference on April 9th in Salt Lake City. LFI is opening the BEC with Passive Investing with Left Field Investors, an event focused on passive investors. This will be where insightful content meets passionate limited partners. If you enjoyed BEC last year and the meetup in Left Field this year, then imagine them both back to back. The Best Ever Conference isn't just any event. It's the premier conference for commercial real estate investors and operators. Your ticket to Passive Investing with Left Field Investors includes admission to the entire Best Ever Conference from April 9th through the 12th. Join us April 9th, where we will have a packed agenda with sessions focused on how to be a successful limited partner, led by experienced LPs, top operators, and partners. Then, immerse yourself in the full Best Ever Conference, where you will be surrounded by like-minded investors, operators, and industry experts for unparalleled opportunities for learning and networking. The best part, and there are so many, but the best part, you won't find a bigger discount on the regular ticket price than the one you get for being an infielder. That's more content for an exclusive lower price. Register for the event today at leftfieldinvestors.com/BEC, and we will see you at Passive Investing with Left Field Investors at the BEC. Have a deal in mind and a group of investors ready to go? Use Tribevest to pool your capital together through a multi-member LLC. Tribevest has streamlined the group investment process, making it easy, quick, and safe to do business with others. Start a tribe and invite your partners to join. Then you can use the platform to collaborate with your partners, pool capital, and manage your joint investments. I'm in 12 tribes myself. It is a great way to learn from others, spread risk, and get into deals at lower minimums. Go to Tribevest.com to get started today.
Any major city is going to have laundromats that are going to thrive. I mean, it's just, you go Memphis, Nashville, Knoxville, Chattanooga, you name it, across the Carolinas. I mean, anywhere in the country. I mean, again, you know, the laundromat industry is not short on cities that it'll do really well in.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
This is Dan Hanford from PassiveInvesting.com, and you're listening to Passive Investing from Left Field podcast.
I'm really excited today to have Sam Wilson with us. He's the founder of Bricken Investment Group. He's been an active investor for more than a decade in self-storage, parking, multifamily apartments, single-family homes, RV resorts, and now laundry facilities. He's also the host of How to Scale Commercial Real Estate, a podcast. And he was a two-time, this is the second time on the show, I should say. He was a guest on episode 58 in April of 2022. So we're excited to have Sam back. Sam, welcome to the Passive Investing from Left Field podcast.
Thank you, Jim. Appreciate you having me back on the show today. It's a pleasure to be here.
Yeah, I'm really excited. First, we've done this before, but I still would like to get new listeners to hear a little bit about your journey. So if you could tell us, how did you get into real estate? How did you get into all these different asset classes and then land in laundromats?
Yeah, that's a great question. How did I get into real estate? I always say it was the good Lord having mercy on an idiot. I sold a business that I owned in Indianapolis, Indiana. I was 30 years old. I had no college education. I'd only worked for myself. And so I was categorically unemployable by anyone else. I just had no other relevant industry experience outside of what I had done. And so I didn't know what to do next. Had money and time on my hands, which I'd like to get back to that point in my life again, because that was a nice confluence of events that are hard to, those two are hard to line up, I'll tell you that. I didn't know it at the time, but regardless, I ended up buying a foreclosure at a foreclosure auction kind of randomly one day. I just kind of stumbled into a foreclosure and bought it, and I made a pile of money on it. And I said, my gosh, I can do it once. Why don't we just keep doing that? And so it's been every iteration of real estate since then. It's kind of wild to look back now. Yeah, it's been a decade, more than a decade since we bought that house. But it's been a wild ride. So I hope that answers your question.
Yeah, it does. And so talk a little bit about the journey from, you started with a single family home, I assume, and it was probably a flip. And I know you flipped a number of single family homes. And then, I mentioned a bunch of different asset classes. So some of it you've been passive, I think, maybe as an LP, and some you've been a GP. So can you just kind of talk about, because it's always interesting to me, I started in single family homes too, and my progression went single, multi, and then I found passive, and I'm like, that's where I want to be. So kind of just talk about the evolution.
Yeah, no, it's a great question. I did 60 plus single family homes from 2013 to 2018. We were buying almost exclusively on the courthouse steps. I thought in 2018 that the single family housing market was getting overheated. Margins were getting compressed, competition was getting tighter, money was harder to come by. And I just said, man, there's got to be something else out there. Started looking at commercial real estate, and that's when we got into parking, which was great all the way until the pandemic happened, which we got out of that by the hair of our chinny chin chin, made a pile of money on it, which is a great time to break out of parking because, there's a whole year there when parking really just was dead, quite honestly. So really there was no viable business option there. And then, and also through that 2018 until even today, I'm an LP in deals across the country. So that is fun for me on that front, of course, to be investing in a lot of different asset classes where I'm not directly responsible, but that also, ties into some of the other asset classes we've gotten into from multifamily, which I'm a general partner in multifamily, but again, primarily just bringing capital to those deals. So it's a great way on the GP side to get involved, to understand it, to be involved in company calls and things like that, but not necessarily directly responsible for the day to day. So everything from storage to multifamily, land is my own thing. I've got some private land holdings on that front, but I don't bring investors in on anything relating to that. So that's just kind of a hobby investment for me. And then actually I started investing in laundromats personally in 2018. So I've owned laundry for the last 5 years, and we'll get into that kind of story. And that's also something I've not brought to our investor base until 2023. RV resorts. Last year we partnered and did 2 RV resorts, again on the GP side with some other partners, because a great chance for me to get in and kind of see the front row or get a front row seat to how RV resorts are owned and operated, and also be on the general partnership side. And then also bought a third RV resort last year that we own and operate ourselves. So yeah, a little bit all over the place, but I would say direct day-to-day responsibility. There's only one asset that we own right now outside of laundry that is something where it's, hey, I've got to be involved in the day-to-day on it. So that's kind of a good way for us to scale without feeling completely schizophrenic.
Yeah, that's a lot of stuff. So I want to jump back into the parking. You said you made a bunch of money because you got out before the pandemic. So looking at, you had this portfolio, I assume, of parking lots, however that works. What was the thing that said, hey, this is the time to get out? Because you did the same thing with flipping, right? You recognized that things were getting competitive, and you exited flipping at presumably a pretty good time. So are you just a genius timer of the market, or what happened there?
Just luck, man. Just luck. I'll say that. We sold in January of 2020, and then also passed on a huge portfolio that had come our way. And I don't know, again, if it was the good Lord having mercy on an idiot or what. Maybe that's my secret sauce. There's the good Lord upstairs, and he's like, man, this guy needs a little extra help. He's not too bright, so we'll give him a little help here. But in January of 2020, we just got an incredible offer on what we own, and we just said, yes, we'll take it. We had a 10-year plan, and we'd only owned a lot of it for like 4 to 6 months. I think we doubled or tripled our investors' money, and it was like, okay, well, yeah, we'll take that exit. And then there was another giant portfolio that had come our way, and I didn't feel good about it. Didn't know why. Didn't feel good about it. So I can't say there was no empirical evidence that I was using to say, hey, this is a good time to buy, a good time to sell. I didn't know the pandemic was coming or anything like that, but we passed on that portfolio, and then the pandemic happened. So we had no parking assets that we owned, which I think parking is great. I mean, now's a great time to get back into parking. I mean, there's incredible opportunity on that front. I'm not going back down that rabbit trail because I've been there and done that. But that said, we didn't know anything. The pandemic happened, and we were like, well, we've made our money, and then we can break clean. So that's exactly what we did.
And you've talked a little bit about kind of the change or how you operate, right? You're an LP on some of these asset classes. You're a GP on some of the asset classes, which is to mean that you're raising capital for others, but you're helping on the deal in different places. And then with laundromats, you are the main operator and GP, correct? So, in our experience together, you've been, I didn't know you in the parking world, but last time we had a conversation, you were doing RV parks, and you were kind of the GP operator, capital raiser, it seemed like you had multiple roles there, and that was the new exciting asset class. And now you're on to laundromats. And I don't mean this in a negative way, but, for an LP, we like some kind of consistency, and the appearance is you're chasing a shiny object. Which one's next? So can you just talk a little bit about that? And how do you approach LPs and say, hey, I'm the laundromat guy. I know a couple years ago I was the RV park guy. Just can you talk about that just to kind of understand how LPs should react to this?
Oh, absolutely. And they should have that kind of visceral sense, that, in their gut check like you just did and go, my gosh, this guy's all over the place. I mean, that it would be my initial response to that if I were an LP looking at me. And I always say that, one of the things, and this is, I'm happy to share any secrets I can for people out there that are scaling their portfolios. Like, I got a front row seat to my own failures. And I'm going to tell you, for better or for worse, I've got all these different assets that we are involved in. And it's probably not, I don't think it's been any detriment to our LPs, but certainly for me on a growth trajectory, not been the most advantageous way to go about it. Picking one thing and sticking with it until you've worn it out is really the best way, I think, to scale your portfolio, both from an LP and a GP perspective, no doubt. But I will say also that I've had my hands in the laundry business and also in the RV resorts at the same time. At the end of 2022, so we did 3 deals last year in the RV resort space, totaling, probably $14 or $15 million in assets that we acquired. And at the end of the year, I looked around and I said, okay, I know laundry. I've been in laundry for the last 5 years, both just personal or just in my own personal holdings. And I said, the RV resorts and the laundry, they're very similar in the way they operate, the fragmented industry, the opportunity that's there. But I see more promise, honestly, in the laundry business from a downside protection standpoint. So at the end of 2022, I said, okay, from a downside protection standpoint, and also just from an overall cash flow and return on time perspective, laundry is killing it 5-1. So now I got a front row seat to both how RV resorts own and operate and how our laundry business that I know very well owns and operates. And I go, well, gosh, there's just unlimited opportunity in the laundry side of things. I'm doing RV resorts. They're going fine. I'm enjoying it. But why not just take what I already know and know very well that I see has unlimited runway and just scale with that? So, yeah, I'm not buying any more RV resorts. And again, I don't think it's any loss to me or to my investors because, we're doing great in the assets that we own. I'm just not adding anything more to that fire unnecessarily. So that's kind of the way I look at what it is that I have done. And all we're doing is laundry. I mean, at this point, yeah, we own the RV resorts, but laundry is all we're doing. It's all we've done all year long. It's all I intend on doing for the foreseeable future because it's just doing really well. So that's where we are.
Yeah, and I think that gives some color to the switch, right? Because you have been doing laundry for a while, and you just weighed out which is the better option. So that makes complete sense to me. Back to the RV park. So now that you're kind of going all in on laundry, where does that leave the investments you did last year in the RV parks? Are you still involved? Or are you still going to make sure that those? Yeah. I mean, you got to shepherd those to the close, right?
Absolutely. And again, I only have day-to-day exposure on one of those, and it requires maybe 2 hours a week of my time at most. So it's not one of our partners is the boots on the ground day-to-day operator there that actually is on site. So I'm not there on site. I don't have to be there on site. We have our weekly calls. We make sure we get the things done that we need to do. And then, of course, the deals where we're more just on the capital side as a general partner, again, my day-to-day exposure there is almost non-existent. So, other than reporting, making sure investments and distributions and all those things are handled, yes, we'll shepherd those to the end, but it's not a massive cognitive bandwidth suck for me.
The laundromats. Let's just jump into laundromats because that's why I had John here. I heard you on another podcast. I was intrigued. I mean, we've known each other for a while, and this is a super interesting asset class. I am guilty of chasing shiny objects, which is okay. I'm an LP. I'm supposed to, even though I got to reel myself back in. So talk to me. You mentioned downside protection. You mentioned that the laundromats are killing it, and I just love the business model you talked about. So just give us the overview. Why laundromats? Why now?
Right. So we'll just start maybe at the top and see if I can logically work our way through this. One is that it is a fragmented industry. It's a lot like the RV resort space in that it's mostly mom and pop owned. It is missing a lot of technological upgrades. Everybody knows the term coin laundry. I mean, I have a question for you, Jim. Why are we still putting quarters in laundry equipment? I mean, some of our machines cost $11.50 to start. That's 46 quarters to start a machine. That's the bulk of the laundry industry. They're going to be, or the laundry industry owners, they're going to be in their 70s. They're going to own some really old stores. They are not up to date. The equipment's broken. I mean, you go in any not any, but I would say 80% of the laundromats that exist today, half the equipment's not going to work. The lights are hanging down from the ceiling. The place is gross. You feel like you're going to catch a disease or get stabbed. It's like, oh my gosh, this place is awful. Like it just needs and we're seeing professional ownership groups come into the space, which is fun. We obviously want to be one of those and are one of those ownership groups coming into the space that's really turning around the reputation that laundromats have. That said, they're also cash cows, which is one of the reasons that people still take coins, because they don't report their income. They don't track and that's another reason why it's still mom and pop owned, is because you got all these owners out here that take all that money and stuff it in their sock drawer and they don't report it. Okay, well, that means that industry can't then grow and thrive, because then they're not taking digital payments. They're not taking Apple Pay. They're not taking credit card payments. And the people that use laundromats, believe it or not, still want to use all of those payment features. So you go into our stores now, and it's like you come in, you can still bring cash, but you put cash into a loyalty card system. Well, now you got a loyalty card that you swipe at all the machines throughout the store. You can use Apple Pay. You can start the machines with your phone. You can there's a lot of things that we do inside of these stores that improve the customer experience. Obviously, rebranding, bringing in brand new equipment, bringing in, completely remodeling the gut in these stores. That customer basis that needs those assets is just unbelievable. And in fact, the worse the economy gets, the better our stores do. So talking about a recession-resistant, inflation-resistant asset class, it's like, well, man, we're there. We've got a base of customers that's only growing the worse the economy gets. It's got incredible margins, and it's inflation-resistant. We can reprice our stores every day like a gas station if we wanted to, right from my phone. So it's like, okay, we've got a unique little business here that just does really well.
Yeah, so I guess it's growing, and obviously when you find all these mom and pops, there's so many ways that you can grow the business and improve things. But a lot of, and maybe this has changed because multifamily is struggling a little bit or is poised to struggle. But part of it, when I look at laundromats, I'm thinking almost every multifamily investment I'm in, they're talking about, hey, we're putting in washer dryers, right, in the units. So every time they redo a multifamily property, which I would guess is where most of your clients live, they're taking people away from you. So maybe you can talk about that. Am I wrong about that?
Maybe. Yes, I hear you in the sense that there might be a washer and dryer in multifamily units. Laundromats thrive in areas where laundromats are needed. So you're thinking Class C-ish areas and or bordering Class C areas. I'm going to use Memphis as an example. Yes, there's multifamily, but in the Class C areas, there's still just a ton of single-family rentals, which is one of the things that we use, is like how many single-family rentals are within a 1 to 3 mile radius. And we use that as one of our key demographic indicators of, okay, is this a good store or not a good store? So that said, yes, maybe you got some multifamily operators that are putting in washers and dryers, but in the areas, these kind of legacy areas where people are renting single family homes, the customer base there's just incredible. So that said, that doesn't really strike me as Class B, maybe. But again, Class B to Class A apartment complexes aren't probably coming to our laundromats anyway.
Aspen Funds has been a consistent supporter of left field investors. You may have seen Bob Frazier on an LFI webinar or at our October meetup in the left field speaking on investable megatrends for the next decade. Whether you're an accredited investor interested in mortgage note funds with a 10-year track record or other macro-driven alternative investments such as industrial, oil and gas, multifamily, or retail, the Aspen Funds team is keeping track of the economic trends and co-invests on every deal right alongside you. Meanwhile, you get to do what you love and make every moment count. Download their free economic report today at aspenfunds.us/LFI.
Hi, this is Zach Happenstall, CEO and co-founder of Rise 48 Equity. At Rise 48, we've successfully purchased 38 different properties worth over $1.5 billion worth of real estate and gone full cycle and sold 11 different properties, drastically exceeding projections for our investors. If you're looking to invest with an experienced sponsor in either the Phoenix, Arizona, or Dallas, Texas markets, then we're the group for you. To learn more about investing with us, visit our website at rise48equity.com and set up a call with me. Thank you.
Talk about the markets then, because I know, I used to own some single family properties in Memphis, so I'm vaguely familiar with that market. And if I remember it correctly, every time you move, you got to bring your appliances with you, right? They don't
Right.
they don't give you a refrigerator or anything like that. So maybe that is unique to Memphis, because I think in most single family rentals you might already have a washer dryer in it. So is this a Memphis thing, the laundromats, or is it able to be expanded beyond that? Or am I just being too narrow focused?
No, it's all over. I mean, it's all over. I've got people across the Southeast, friends in the laundry industry, and it is. I mean, any major city is going to have laundromats that are going to thrive. I mean, it's just, you go Memphis, Nashville, Knoxville, Chattanooga, you name it, across the Carolinas. I mean, anywhere in the country. I mean, again, the laundromat industry is not short on cities that it'll do really well in. And that, I think, to your point, I guess I've owned a lot of single family rentals over the years, and I don't think we put appliances in any of those, Memphis or otherwise. Maybe it is that way in other cities, but yeah, I've just not experienced that. So
Okay.
I don't know if that gives any color to it or not.
Yeah, no, I mean, it's certainly a growing market, it seems, and I think the key probably is you take these mom and pops who are ready to sell, and they've already made their money off it, and it's cash flowing for them, and then you go in there and upgrade everything and make it nice. Now, is this similar to car washes in that it's an operating business and a real estate play together?
That's a great question, and I'll give some color maybe back to what you're comment about. They've made their money on it. Yes, they've made their money on it, and they're tired, and it is an operating business, and that's probably one of the reasons that you get these legacy owners that are tired. I mean, one of the recent stores we bought, this guy was 74, and he's staring down the barrel of putting in $500,000 in new equipment, gutting his store, starting over from scratch, basically. He goes, what am I going to be, 85 or 90 when I get all this paid off? He goes, I'm tired, man. I've done this for a long time. I want out. So that said, and also their revenues have just, as those stores get older and as their equipment stops working and breaking down more often, their revenues do decline. I mean, we took the first store we bought, it was doing $4,000 a month in gross revenue. $4,000 a month. That store does over $40,000 a month in gross revenue now, with almost no money spent on ad spend, just bringing a brand new product to market. And when you build it, it's kind of crazy. They do come, and we keep seeing this happen over and over and over. It's like you bring a brand new store with brand new equipment and brand new payment systems and staff it and offer wash, dry, and fold and offer delivery, and the revenues kind of take care of themselves. So that said, is it a real estate play or is it a business play? It is very much a business play. There is real estate involved, no doubt. But we will also take stores on leases. So that answers your question, I think, right there, is that yes, it's an 80% business, 20% real estate play. And just especially if you're buying standalone stores, which we own, standalone stores, the real estate plus the business. But without the business, the real estate's kind of worthless because it's an independent standalone laundromat. And what else is it going to be besides a laundromat? So does that answer your question?
Yeah. And how does depreciation work on a laundromat? Because I know on the car, I keep comparing it to car washes, but
yeah,
car washes have really excellent depreciation because some of the business gets rolled into that. So is that the same with laundromats?
Yeah, absolutely. So, I mean, and again, we'll do cost seg studies, especially if we have the real estate and the business as well. But even all of our major equipment, we can either choose a Section 179 that. I think it's up to $1.2 million, I think, a year. And again, I'm not a tax accountant, so don't take this as you don't take this as tax advice, because I'll probably get something wrong somewhere, which is why we pay them the money to take care of it at the end of the year. But, you can Section 179 up to a certain amount of money. And if you go over that, then we can do bonus depreciation. So I think this year we've got 80%, I think, left. So we spend, let's say on a single store, $500,000, we can write off $400,000 of that in the first year if we're doing it via bonus depreciation.
And what's Section 179?
That, yeah, you're now we're getting outside of my
just
knowledge base entirely. Generally, it's like where you can say, okay, we own a business and we can expense in that first year up to I think it's $1.2 or $1.1 million in whatever that is, new equipment, and just write it all off in year one as a direct expense. Now, how does that affect whether or not you capitalize that equipment? How does it affect the balance sheet? I don't know the answer to that question, but I do know that is an option outside of maybe claiming it under bonus depreciation and or cost seg studies.
So an LP will get some kind of paper loss in year one.
Oh, absolutely. Okay. That is one of the things that we strive for.
And I heard you mention on another podcast, and you briefly mentioned it here, delivery, wash and fold, I think you even mentioned something about DoorDash or something being part of this. Can you talk about all of that? Like, because it's not just people going in, washing their clothes, drying them, and leaving, right? You have other verticals.
Yeah, absolutely. And the way I like to put that is that we get to serve kind of every income tier in their own unique way. So you have your self-serve customer, which accounts for about 60% of our revenue across the board. I mean, maybe it varies a little bit, but on average, 60% of our revenue comes from that self-serve customer that comes in, washes their clothes in our machines, dries them in our machines, and takes them and goes home. So that's one. Number two is about another 30% of that of our revenue accounts for drop-off orders. Believe it or not, everybody from the mechanic down the street that doesn't want to do his laundry on the weekend to, giant families that are, they got 5 to 7 kids and like, man, I just can't keep up with the laundry. They'll bring in 55-gallon bags at a time of trash bags full of clothes for our staff then to take and wash, dry, fold, and they'll pick it up the next day all nicely, bagged up and ready for them to take home and just put away in their drawers. So we do a ton of that drop-off business. And then the third thing we do, and it's a growing segment, but we integrate with DoorDash, with Uber, with on-demand delivery services, and also we have in-house drivers where you can order it right from our website. Get on the website, type in elleslaundry.com, and you can order laundry, and we'll come and pick it up at your door that morning, and then take it back to our store. Our staff wash, dry, and fold it, and then you'll get it delivered back the next day, again right there on your doorstep. So you get to kind of serve each unique kind of income earner in their own unique way. And those are going to do different at different cycles or in different economic cycles. But that's some different ways that we're able to do the laundry business that are kind of some bolt-on services that, again, going back to the mom and pop owner that's taking quarters in their machines, they just don't have the capacity to really add those services to what they do.
And I heard you mention also short-term rentals because, I know a couple of short-term rentals that have 2 laundry rooms in the actual house. And because when they do a turn, they have to wash everything so fast that they need 2 washers and 2 dryers. So you're working with short-term rental companies as well.
Yes, good. Yeah, you did do your homework, Jim, and I appreciate you bringing that up. Yeah, absolutely. You get these large management companies. And, if it's a scaled management company and they've got 50 or 75 short-term rentals, what they're going to do is standardize what they put on. All the bed sheets are going to be the same. All their pillows are going to be the same. Everything's going to be the same. So we operate right within them and actually have dedicated, shelving space and racking space for these different companies because their cleaning crews will just come in, pull comforters, pull pillows, pull whatever it is. And they just drop off laundry and pick it up all week long and just use us to do their turns because they can't turn them fast enough. With the challenges of turning a house, say they pick it up at 10 a.m., they got to have it turned and ready to go by 4 p.m. Well, that can be a real challenge if they don't have the right or the fast enough laundry equipment there in the actual facility. So they just utilize us as a third party to get all that done.
And now I want to kind of pivot to how does an LP look at this? Like, what are the expected returns? And again, this is general, not of, and I think this is, you're not investing in one deal. It's a fund. So can you talk about this deal structure and how LPs can invest in this?
I will give you kind of some background as to why we set this up the way we did. There was a lot of thought that went into this. Like, okay, do we do this in 3 to 5 store segments? Do we, how do we set this up? We came to the conclusion that it has to be in a fund. It has to be in a fund because, one, if we're going to buy 10 or 20 stores in the Memphis area, we want all of those to be under one common ownership. They don't need to be competing with each other. If you did 5 different syndications, then you have 5 different groups of people competing for the same amount of business, which doesn't make any sense. So it is a fund. It is. We do have several stores already in that fund. The way to think about the laundry business is that it's not an appreciation play. Like, this is a cash flow play. You're looking at a double-digit return annually, cash on cash. And outside of that, that's really the way that we've kind of just structured it is, hey, this is we have an intended 8-year hold. And again, I'm not going to get the specific numbers on it. You can download the PPM, all that stuff right off our website, sign up there and you can get all the information there. It is a 506c fund, but the cash flow is what we're looking for. And that's what you're going to get in the laundry business. Yeah. If we aggregate a portfolio of 25 or 50 stores and decide to sell those in 8 years, what will that multiple be when we exit? We don't know. Why? Because it's really never been done. Nobody's ever institutionalized at scale the laundry business, which is one of the things we're looking at. It's like, okay, how do we meaningfully grow this such that in 8 years we have 25 or 50 stores to sell off all at once as a portfolio sale? But, one of the challenges we ran into in underwriting is you go, all right, well, what's that look like if you sell 50 stores all at once? Well, we don't know. You don't know because it's never been done. It's not, you can pull the data for multifamily or for self-storage or for any of those other asset classes and say, this is what this looks like. So we said, you know what, let's be stupid conservative here. We know what we can get on a return profile basis because we have firsthand experience in it. So what we can project is cash flow for 8 years and then exit and basically, get your money back. So clipping a very healthy coupon is kind of the way I like to think about this business and kind of an investor's approach to it. It needs to be an investor that is income focused and not necessarily growth focused, if that makes sense.
Yeah, and I guess the question there is in the docs and stuff. Again, we don't want to go through the whole PPM, but
Sure.
Is there an upside for the LP? Meaning, if you do sell and have a big exit because you find a REIT who now wants to be a laundromat REIT because you've invented a new thing, does the LP share in those gains?
Oh, absolutely.
Okay.
Absolutely. Yeah, and that's one of the things that go if you download all the documents and there's I think we've set this up to where it's really investor friendly.
We're still talking about the LP. How does an LP, because there's two parts to, well, there's more than two parts, but two main parts maybe to an evaluation for an LP. One is the operator. So how do we evaluate a laundromat operator? Because is there only one? Maybe there's a few more, but you're the only one I know. And especially you're not new to the asset class, but you're new to syndicating it, right? And it's a unique and different asset class. So as an LP, I'm thinking, okay, first thing I want to do is evaluate you and you as a laundromat operator. So what are some things that I should be looking for? What are some questions I should be asking you?
Yeah, I guess what is the plan as far as revitalizing these stores? Are you buying? Are you buying new? Are you building from the ground up? I guess that is buying new, but are you building from the ground up? Are you remodeling existing stores? How are you acquiring those assets? What are you doing from a point of sale, from a technological improvement side of things? Like, what's that look like to bring the laundry business into 2023? What's it look like from a management perspective? I mean, because this is a management heavy business. Like, who are your team members? Who are your boots on the ground? How are you handling point of sale systems? Are you guys offering ancillary revenue or ancillary services to you? And then how are you bringing those ancillary services in? Is it you guys marketing it? Are you partnering with third party vendors that are helping you do that? What do a lot of those things look like? So I guess it would probably be more on the operational side of things, like what that plan is and how you plan on executing that, because it is there's a lot of moving parts here, and those are probably the things I'd want to know more than anything. If it's a buy one store or two stores and let them run sort of thing, there's just I don't see legs growing underneath that. So those are probably a few of the things that would come to mind initially. Okay,
and then the second part, and part of that, it's kind of because it's in a fund, and it's almost like the analysis of the deal is almost the same as the analysis of the sponsor or the vetting of the sponsor, right? So are there any metrics that we should be looking at, like, in multifamily might be economic vacancy or, the rent growth or the, some of those other metrics that we look at? Do we have that for laundromats? Is there?
Oh, yeah.
Or is it just like how many different revenue streams do you have? How many verticals or what's the analysis there?
Verticals, and then the other thing you want to look at is just, what are the demographic studies? I mean, we spend a lot of time looking at demographic reports when evaluating an area, and it may vary city to city. Like Memphis, your average household income might be slightly less than what you'd expect, obviously, in a good laundromat in Nashville. Nashville is much more affluent maybe than Memphis is overall. So you want to say, okay, or at least the household income has got to be more in Nashville than it is in Memphis. So looking at those demographic reports, how we're interpreting them, that's a lot of what we spend time on, is looking at those, and just because there's areas that we'll pass on because they may make too much money within a certain striking distance of that store. And it may be like, and I've passed on stores for that very reason. It's like, well, everybody's making $120,000 or more a year within 1 mile. This doesn't make any sense to have a store in this location. So that's what we spend a lot of time looking at.
And you mentioned competition. There's other people doing this. And other than the mom and pops that you're trying to target and buy, in your markets, what are the competitors? Not their names, but what are they doing? How much competition is there? When you find a property, is there usually another buyer, or is it just you?
There could be another buyer here in Memphis. I only know one other person that's actively buying stores, and I'm actually glad for it, because again, we're taking an industry that, man, it's just rough. Like, there's one of our stores that we bought in January of this year. I honestly wouldn't wash my dog in the 5 closest stores to that store. I just wouldn't do it. It's like, man, these things are disgusting. So it's really great to see other people come in the space. It's kind of like quality multifamily operators coming in. It kind of rising tide, raises all ships sort of thing. So I'm glad to see some other more professional owners come in, making nice new stores. So yes, there is competition out there. What we have found as a way to differentiate ourselves from our competition is, one, we have staff stores. So a lot of times you'll go into a laundromat and there's nobody there, right? You just walk in, you're like, okay, well, I got to find out what machine. I don't know what machine to put this stuff in. Which one does it fit in? Where do I buy soap again? So we put staff in our stores. So when you walk in, it's kind of the Chick-fil-A model where it's like, hi, welcome to Ellie's Laundry. Like, oh, okay, well, I'm not used to being greeted when I walk in the door. Good to see you too. Having a robust phone systems that roll over from store to store. So when you call, you don't get just stuck out in, the nether sphere of trying to figure out what's going on. The third thing that we do is really, that I think sets us apart more than anything, is our community engagement. So we spend a lot of time, we have team members that help focus this in partnering with, there's some books to birth programs there. We put libraries in all of our stores. So when you walk in, like, the bookshelves there's bookshelves throughout the stores. We put reading rooms or reading areas in for kids. We put kids' playroom, in there. And then we partner with other organizations that'll come in and do free laundry, a couple times a month for seniors groups or for Medicare groups or for whatever it is. So maybe churches, there's other partner industries that'll come in, or other partners that'll come in, host a free laundry night. So we'll split laundry with them. And so they get to come in and, bless the community. And those nights, of course, pack the house out. It costs us nothing because we do it at cost with those groups. And so we do some of those community engagement things. We partner with the schools and give vouchers to the school counselors. So if they have kids that come, because truancy and kids that don't get their clothes cleaned is a big deal, because what kid wants to come to school stinking? And so we'll partner with them and give them laundry cards where they can just hand those out to families in need and say, hey, you know what, go to Ellie's Laundry and they'll wash your clothes. You look like everybody else. You just walk in there and swipe your card and you blend right in. So we do some of those things that really, and those are just a few of the things, the libraries, the kids areas, the free laundry events, the partnering with schools that really drive community engagement. And that's a big deal. So even though we have competition, like our best store, there's probably 4 laundromats within a mile and a half, and we're by far the busiest laundromat in the area. And we're the most expensive. That's the other thing too, is that I have no problem being a price leader in the business. It's like we bring a really great product to the market. They're super clean. You walk in, you get greeted. And so I keep our prices in line with the product that we're offering, and people are willing to pay for it. So all of that said, we kind of got a little secret sauce there in the way that we engage the community, and that so far has made all the difference.
That's great. And I heard you mention it a couple times. So you did brand this. Are they all Ellie's Laundry? Is that the goal? Is Ellie's Laundry is the brand name?
That's it, man. Ellie's Laundry, Ellie'sLaundry.com. You got it, man. That's the name of the brand. Awesome.
And for those of you that aren't on YouTube that are listening, he just showed me his hat. It's pretty sweet hat with the website on it. So that's awesome. So Sam, the last question I always ask is, what is a great podcast that you listen to? You cannot say How to Scale Commercial Real Estate. That'll already be in the show notes. That's an awesome podcast. You got to pick something else other than that.
A great, Jim, I told you, I think I said this in the onboarding questionnaire, I host my own podcast, and so it's really tough. 850 some odd I get to have people like you on all the time, and so I get a front row seat to ask all the questions I want of some of the best guests in the country. And so it's really hard to get out after that and listen to other real estate podcasts. I'm like, oh man, I've already had all of the best guys on the show. But that said, a great podcast that I listened to. Okay, here's a fun one. I haven't listened to it in a while, but I really enjoyed it. I can't remember the name of it, but it was all about sounds, like 20,000 hertz or something like that. Have you heard of this one?
I haven't.
Yeah, so he goes through and I loved it when I listened to it, but it was all about sounds. and they interview like everybody from the voice of Siri to what different sounds, and you wouldn't think that you could make a fascinating podcast, but if you're looking for something that's just kind of a brain break and you're like, oh, that's really, really interesting how they break down what sounds do. And then they did one on the national alert, the whatever it is, that sound, and how that's a trademark sound, and you can get fined like thousands of dollars if you play that sound over the air. So don't do that, by the way. But that's a great podcast that I've listened to just for listening pleasure. Going, man, that's really, really interesting, and I learn something new every time.
Awesome, that's great. Doesn't have to always be about real estate all the time. So I appreciate that recommendation. Last question: if listeners want to get in touch with you, learn more about you, your company, or Ellie's Laundry, or if someone just needs to wash a couple of shirts, what's a great way to get in touch with you?
Man, you can always check out our stores at elleslaundry.com, but the best way to get a hold of me is Bricken Investment Group. That is the name of our company, brickeninvestmentgroup.com. That's BRICKEN investmentgroup.com. You go there, you can learn all about the Laundry Fund, and there's ample ways to also get in contact with me there directly.
Awesome. Well, thank you so much for being on the show. This was fascinating. Another new asset class, which I love learning about. So thanks for your time. We appreciate it.
Thank you, Jim. It's great being on.
As a busy physician, I know exactly what it's like to work long hours, make sacrifices, and put your patients first. I wanted to create more freedom for my family, but I didn't know where to turn. So in 2012, I discovered the power of multifamily real estate investments. This allowed me to create passive income and freedom and wealth for my family. In 2015, I co-founded multifamily syndication investment firm Viking Capital. My name is Vikram Raya. I'm CEO and co-founder of Viking Capital, and we believe that multifamily investing presents a significant opportunity for investors to build sustainable wealth and achieve financial freedom through diversification. Learn more about all our current deal offerings at vikingmultifamily.com.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Suh, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book on syndication investing I have read. It's an easy to read book, chock full of great advice from Steve's experience as a passive investor. This is a must read, whether you are a first-time passive investor or a veteran. Hit the link to Avoiding Rookie Errors as a Left Field Investor on our website today at www.leftfieldinvestors.com. I always have a great time talking to Sam. One of the things he's just authentic and transparent about what he's doing and where he's at. So I definitely appreciate that. He was flipping houses. I forget how many he said he flipped, but a bunch. And he recognized it was getting more competitive. And he says it's just dumb luck that he got out in time, but he exited that. And he did the same thing with parking lots, right? He got out at a good time, and he can call it dumb luck. But when you continue to do it, maybe it's a little bit something more than that. And it's okay if luck is part of your success. That's just the way things are, right? You can have a little bit of luck. You need more than just luck, but you can't just say, hey, this is luck when it's repeated. And again, the fact that, I asked him, hey, what do you're changing asset classes all the time, and how are people going to evaluate that? He was totally, that is something you should ask. That is something you should look at. He agreed that it looks like he might be all over the place, but when you dig into it, he's been in the laundromat business for 5 years, as he said. So it's not like he just switched from RV parks and parking lots to laundromats on a whim. He was doing both, and he found out which one was going to give the best return to him and to his investor community, and so he went all in laundromat. So I presume next year at this time we'll interview him again, and I think he'll still be in laundromats because he sees the potential there, and that makes sense. And part of it is, he's buying all these from mom and pop that run down, dirty, gross. I'm sure we've all been in a laundromat before. They aren't places you want to hang out. But if you update them with all this new technology, so I can just start the washing machine and pay for it from my phone, that's fantastic. And then you put a library in there and a play area for kids, and you get community engagement. Now you're making this a comfortable, safe space that I can go do my laundry and read a book while my kid's playing next to me. And that just solves so many problems at once, rather than dragging my kid to this dirty, dingy place where nobody's at, and you're nervous, and you got to go to the bank or wherever I don't even know where you go to get quarters, because you got to have 40 quarters to run the machine or whatever he said. So it's just the change that he is putting into these. It just makes it compelling, and he can charge more because of it. And multiple verticals, right? We always taught you want more than one cash flow stream. And that's whether you're a business or whether you're a person, right? And so he has the self-serve, he has the wash and fold, he has delivery, he has short-term rental people who come through. So there's all these different verticals, and there's all these different ways that he can make money, which allows him to staff it, because now he doesn't just have staff sitting there watching you do your laundry. They are there to help you, but they're also folding laundry and doing other stuff. So the operations just sounds like it makes sense to me. You just have to recognize it's a cash flow play, not appreciation. That doesn't make it bad, but you have to realize that we don't know what the exit is, right? It sounded like it's an 8-year fund, but you don't know what's on the other side. You don't know who he's going to be able to sell it to or how he's going to be able to sell it. But if you're making significant cash flow along the way, it doesn't matter as much. You don't need a 2 or 3x because you've gotten your money along the way, and that also de-risks it. So super interesting new asset class. I always like learning about that stuff. So super glad that Sam was able to come on and talk laundromats with us. So that's all we got for this time. We'll catch you next time in the left field. Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.